All right, hello and welcome to another session of the My Solo 401k Financial My Community Daily Webinar Series. We're on a weekly YouTube session. Thank you so much for joining. We're about to get started. Got some great content here. We're focused on the Mega Backdoor Roth Solo 401k Contribution Guide for 2023 as well as 2024. Focused on businesses that are taxed as a partnership. So it could be a multi-member LLC or just two individuals that are filing and operating their business as a partnership, filing a 1065 where the owners receive a K-1. So we we want to focus on that type of business in terms of how much they can contribute, specifically for those that are looking to make mega backdoor Roth contributions. So first of all, the presentation is being provided for educational purposes only and should not be construed as tax, legal, or investment advice, nor as a solicitation. When making an investment decision, please consult with your tax attorney and financial professional. So we first want to highlight that we're in the middle of our annual series of doing these deep dive contribution webinars. So up next in the docket, we've got some great content. For example, next week, we'll be hosting another deep dive session focused on businesses that are taxed as sole proprietors. Could be a single member LLC, taxed as a disregarded entity. We'll also have a session regarding making mega backdoor Roth contributions for that type of business. We're also going to host a series of webinars that are focused on how much income one needs in order to be able to maximize contributions. So this will be for businesses that are taxed as an S or a C, as well as another session focused on businesses that are taxed as a sole proprietor, a single member LLC, businesses that are taxed as a partnership or a multi-member LLC, like today's session. So all you need to do is simply subscribe to the YouTube channel and you'll get notifications, you'll get access to the recordings. So please, stay engaged so we can make sure to get all the great content to you. So for today's session, we're going to focus on the contribution limits. We're going to then apply those limits to different scenarios and examples to really see how it works. We're going to talk about the resources like our online calculator. We're going to focus on all the mechanics like the deadline, how to make contributions, how to report contributions. And since we want to really also zero in on individuals that are trying to make mega backdoor Roth contributions, we want to talk about the mechanics of transferring from an after-tax account to a Roth account. And then we want to add some additional bonus content regarding the $1,500 solo 401k tax credit. So with that stated, let me just make sure we highlight this clearly. Thank you so much. So we want to talk about the benefits of a mega backdoor Roth solo 401k. Yes, thank you so much. So really the benefit in simple terms is that one is able to maximize the dollars that are going into a Roth solo 401k. And as you'll see as we go through the slides, the way that you're able to do that is by making what are called voluntary after-tax contributions, because the voluntary after-tax contribution limit is higher than your typical Roth employee limit. So this is how one is able to contribute as much as $66,000 or even $73,500 if you're 50 or older to a Roth Solo 401k for 2023, $69,000 or $76,500 if you're age 50 or older for 2024. And once it's in that Roth Solo 401k, now you've got that potential for tax-free growth. Ultimately, when you take the money out, as long as it's a qualified Roth distribution, you've had the account for at least 5 years and you're at least 59 and a half years of age, all that subsequent growth is going to be tax-free. So it's got tremendous, it's a powerful tool in the toolbox, essentially. Now, in order to make these mega backdoor Roth solo 401k contributions, you need to, number one, be eligible to set up a solo 401k. So you have to be self-employed with no full-time non-owner, non-spouse W-2 employees. And then you have to have a solo 401k plan that supports the mega backdoor Roth. So, for example, the solo 401k plans at the discount brokerages, they don't support the mega backdoor Roth, because in order to be able to make a mega backdoor Roth contribution, you have to make what's called a voluntary after-tax contribution and then process an in-plan distribution, either a conversion or a rollover. So either you're transferring the funds from the voluntary after-tax solo 401k account over to a Roth solo 401k or a Roth IRA. So you have to have a plan that allows for that, and you want to work with a provider like us that has tremendous experience in helping clients and navigate through all the requirements, like having separate accounts for the voluntary after tax versus the Roth, as well as handling the ongoing compliance support. Because even though that voluntary after tax contribution is not reportable, the subsequent transfer from the voluntary after tax solo 401k sub account to either the Roth solo 401k or the Roth IRA is going to be reportable on a 1099-R. And we handled that required reporting as part of our service as an optional free service. In other words, for no additional charge. Now, anytime we talk about how much one can contribute to a solo 401k, it's important to recognize that there's different factors that go into the answer to that question. One, of course, is your self-employment income, because you can't save more than you earn. And you have to use your self-employment income to justify those solo 401k contributions. So even though you can certainly have a day job and then set up a solo 401k for your separate side business, you can only use the income from your self-employment activity to justify contributions to the solo 401k. So number two would be your age. So once you're age 50 or older, you're going to be able to contribute more because you can make what's called a catch-up contribution, which is up to $7,500 for either 2023 or 2024 that you can make as a catch-up contribution. Another important consideration is whether you participate in another plan, like a day job plan. And if you're making contributions to that day job plan, that's going to reduce the amount of employee contributions that you can make to the solo 401k. And we'll review that more closely. Lastly, would be the type of contribution. So are you looking to make employee versus employer? Are you trying to make pre-tax or Roth or voluntary after tax? So all of those variables will impact how much you can contribute to the solo 401k. One second. Thank you for your patience. Okay, so let's zoom in a little bit more. So in terms of your self-employment income, for a business that is taxed as a partnership, self-employment income is equal to line 14 of the K-1 less 1/2 of the self-employment tax. And we have a calculator on our website that will help to run these calculations for you. We're also fielding questions every day from our clients in terms of helping to educate them on the rules and how it applies to their specific situation. Now, again, you can only use the income, your earned self-employment income. So you can't use investment income. You can't use W-2 wages that you might receive from a day job. It's got to be based on that earned self-employment income, which for a business that's taxed as a partnership is the amount reported on line 14 of the K-1 less 1/2 of the self-employment tax. So in other words, you have to run a pre-calculation. Once you've determined that self-employment compensation, then you can know and determine exactly how much you can contribute to the solo 401k. So once you know your self-employment compensation, now you've got to understand the different contribution limits, right? So you have the overall limit. So the sum of all contributions made to the solo 401k, whether it's employee, employer, voluntary after tax, cannot exceed the overall limit. So for 2023, the overall limit is $66,000. plus an additional $7,500 if you're 50 or older. Whereas for 2024, the limit goes up to $69,000 plus an additional $7,500 if you're 50 or older. So now let's zoom in. Once we understand the overall limit, let's start to talk about the different types of contributions. So in the words of the IRS, you're both the employee and the employer. So you can make both employee and employer contributions. This is why the solo 401k has the highest contribution limits for any defined contribution plan available to self-employed individuals, because you're able to make the various types of contributions to really maximize the funds that are going into your solo 401k. So let's first talk about the employee contribution type. So this employee contribution, if you have a plan like ours that allows it, can be made as either a pre-tax, Roth, or even a voluntary after-tax. Now, voluntary after-tax contributions, the limit comes from a different section of the code. So it's not impacted. The voluntary after-tax contribution limit is not impacted by contributions that the individual makes to a plan sponsored by an unrelated employer, like a day job 401k plan. Whereas the Roth and the pre-tax contributions, those are impacted by contributions made to a day job plan. Then you got the employer contributions. So historically, those employer contributions were always made exclusively as pre-tax contributions. Now, thanks to Secure Act 2.0, you can make the employer contributions as Roth contributions. And we'll talk more about some recent IRS guidance here in a few slides in terms of how one has to report those employer contributions. Now, unlike the Roth and pre-tax employee contribution limit, which is impacted by contributions made to a day job plan, the employer contribution limit, like the voluntary after-tax contribution limit, is not impacted by contributions made to another plan, like a day job plan. In other words, the employer contribution limit applies at the employer level, which makes sense from a policy perspective, because otherwise an employer would have to check with each employee to see if contributions were being made to another plan by an unrelated employer. So that type of coordination would probably be impractical. So now let's move down to the second half of the slide here, the bottom half, Roth contributions. So those types of employee contributions, as long as you have a plan like ours that allows for it, have always been able to be made as Roth contributions. So that's going to include the catch-up contribution, in other words, the $7,500 for someone that's age 50 or older. And now, thanks to Secure Act 2.0, employer profit sharing, or what they also call non-elective contributions, can be made as Roth contributions. And then you got the voluntary after-tax contributions. So voluntary after-tax contributions would not include the catch-up amount. So if you're over age 50, if you're 50 or older and you have the self-employment income to justify it, you could make a $7,500 catch-up contribution, but you wouldn't be able to make that as an after-tax. You'd have to either make that as a pre-tax or a Roth. And then, like I mentioned up above, even though a voluntary after-tax contribution is a type of employee contribution, it's not impacted by contributions made to another plan, like a day job plan. So now let's zoom in a little bit more and talk about the different limits that apply to these different types of contributions. So keep in mind, we're focused on businesses that are taxed as a partnership. And so anytime you're making solo 401k contributions, your ability to do that is based on your self-employment compensation. So what your self-employment compensation is depends on how your self-employed business is taxed. For a business that is taxed as a partnership, remember, you have to run that pre-calculation where you would take line 14 of your K-1 less 1/2 of the self-employment tax. Now, once you've determined that number, you now can determine how much you're going to contribute, how much you can contribute, then you can determine how much you want to contribute to the solo 401k. So in terms of the employee contribution limit, you can contribute 100% of your self-employment compensation, dollar for dollar, up to $22,500 for 2023, plus an additional $7,500 if you're 50 or older. Now for 2024, that limit increased to $23,000 or $30,500 if you're age 50 or older. The employee contribution limit, that applies at the employee level. So you need to reduce that amount by any contributions made to another plan, even if sponsored by another unrelated employer, like a day job 401k plan, unless the other plan is a 457 governmental plan, in which case the contributions are not aggregated. So those employee contributions, what they also call salary deferrals, they can be made as pre-tax to reduce your taxable income for the year for which the contribution is being made, or they can be made as Roth, in which case it wouldn't reduce and be made on a pre-tax basis, it'd be made on an after-tax basis, but then you'd have the potential for tax-free growth. The limit is the same, right? It's 100% of self-employment compensation up to $22,500 for 2023, $23,000 for 2024, plus an additional $7,500 if you're 50 or older. If Roth contributions are being made, they need to be deposited into a separate sub-account. So for our clients, we're very hands-on in helping them open up accounts at the bank or brokerage of choice. So if someone wants to make pre-tax as well as Roth or even after tax, then we would prepare the paperwork to open up the requisite number of accounts at the bank or brokerage of choice. So now let's talk about the employer contribution limit. So employer contributions, they're also referred to as profit sharing. They're also referred to as non-elective. These are all synonyms for the same type of contribution. So unlike the employee contribution, where you can contribute 100% of the self-employment compensation, dollar for dollar, up to the applicable amount, with the employer contribution limit, it's a percentage of your self-employment compensation. So you always have to first run that pre-calculation, right? For a partnership, multi-member LLC, tax as a partnership, a business that's filing Form 1065, self-employment compensation is line 14 of the K-1, less 1/2 of the self-employment tax. And once you've determined that amount, then the employer contribution limit is 20% of that amount. Now we have to always keep in mind the overall limit, right? So the sum of any employee, employer, plus any voluntary after tax that you want to make to the solo 401k cannot exceed the overall limit, which again is $66,000 for 2023, or an additional $7,500 if you're 50 or older, $69,000 for 2024, or an additional $7,500 if you're 50 or older. Now, unlike the employee contribution limit, which applies at the employee level, where the employee has to aggregate any contributions that they make to another plan, like a day job plan, along with any contributions that they want to make to the solo 401k to see if they've hit the limit, the employer contribution limit is not impacted by contributions made to another retirement plan, like the day job plan, with the one exception being if those contributions were being made to a 403b. In the case of a 403b, any contributions that are made to the 403b, in other words, contributions made by the employee or for the employee, like an employer contribution, together with any contributions that you would want to make to the solo 401k, cannot exceed the overall limit. Now with Secure Act 2.0, employer contributions, these non-elective contributions, they can now be made as Roth contributions. For solo 401k plans like us, like the plan that we offer that allows for the mega backdoor Roth, in our experience, many clients would choose to not make employer contributions as Roth contributions because they could always just simply make those contributions as voluntary after-tax contributions. So why would that be? Well, the voluntary after-tax contribution limit is effectively higher than the employer contribution limit, right? Because the voluntary after-tax contribution limit is 100% of your self-employment compensation, dollar for dollar, up to the overall limit. Whereas the employer contribution limit we just saw is 20% of self-employment compensation for a self-employed business tax as a partnership. The deadlines are the same. So the deadline to make either employer contributions or after-tax contributions is the business tax return deadline, including any timely filed extension. Now, it's noteworthy that even for someone who didn't set up a solo 401k by the end of 2023, they could still set up a solo 401k here in 2024, as long as they set it up in time to make the 2023 either employer or after-tax contributions by their business tax return deadline, including any timely filed extension in 2024. So let's say they filed a timely extension for their Form 1065, the partnership tax return. Now they're going to have until September to be able to make those either those employer or after tax contributions. So there's no difference in terms of the deadline. There's no advantage of making the contributions as employer versus after tax. Now keep in mind, for someone who didn't set up their solo 401k by the end of 2023 and whose business is taxed as a partnership, it would be too late to make employee contributions, but they could still make employer. So those voluntary after-tax contributions, they could be transferred out to a Roth IRA, whereas employer contributions could not, if employer contributions that are made as Roth contributions cannot be transferred out of the solo 401k unless the individual has met a triggering event. For example, they're age 59 and a half or greater. So that would be a third reason why individuals would choose to make contributions as after tax as opposed to making employer contributions as Roth, right? They have more flexibility if their goal is to be able to transfer the funds out of the voluntary after-tax solo 401k sub-account to a Roth IRA. But let's assume someone still wants to make employer contributions as Roth contributions. So what are some of the frequently asked questions? Do I need to deposit those employer solo 401k contributions made as Roth contributions into a separate account? Well, they do need to go into a separate account for Roth funds, but it could be the same account that the individual may be making employee Roth contributions to. So you could have both employee and employer contributions made as Roth contributions deposited into the same bank or brokerage account for the solo 401k. Number two, what is the contribution limit? What's the same contribution limit that applies to employer contributions generally, whether it's made as pre-tax or Roth? It's 20% of self-employment compensation, right? Remember, self-employment compensation for a business tax as a partnership is going to be line 14 of the K-1 less 1/2 of the self-employment tax. Now, lastly, how do I report those employer solo 401k contributions? So even though employer solo 401k contributions made as Roth contributions, so even though Secure Act 2.0 was enacted at the end of 2022 that allowed for these employer contributions to be made as Roth contributions, there was a question as far as how to report those contributions. So that question was finally answered recently with IRS Notice 2024-2, where the IRS clarifies that employer contributions made as Roth contributions are still going to be tax deductible on the employer's return for the year for which the contributions are made, the Form 1065. But then they're going to be reported as taxable to the employee for which the contributions are deposited on a Form 1099-R. So in terms from a reporting perspective, it's going to be just like the individual had made an employer deductible pre-tax contribution, reduced the taxable income on the employer's return, but then immediately converted the funds over to a Roth solo 401k as an in-plan conversion. So now it's reportable as taxable to the employee on a Form 1099-R. So oftentimes individuals are making these employer contributions by the business tax return deadline, including any timely filed extension. In other words, they're making the contributions for the prior year, right? Individuals are making employer contributions for 2023 now, here in 2024. And so if those employer contributions are made as Roth contributions, they're going to reduce the taxable income on the 2023 tax return of the employer, the Form 1065, but then increase as taxable on the employee's tax return for 2024. In other words, the year of the deposit. Because ultimately it needs to be taxable, right? Because the contribution is being made as a Roth contribution. So now let's talk about the voluntary after-tax contribution limit, right? Voluntary after-tax contributions are how one makes mega backdoor Roth contributions. And we'll see here on this slide, right, that the limit is much higher than the employee limit, even the Roth limit, right? Because in order to be able, because we know that with the employee limit, right, it's the 22,500 that the individual can contribute. Now with Secure Act 2.0, the individual, if they have the self-employment compensation to justify it, could make another Roth contribution as an employer contribution or an employer contribution as a Roth contribution to deposit more funds into the Roth account, but they can only contribute 20% of their self-employment compensation. So they would need a fair amount of self-employment income if they want to be able to hit that overall limit of $66,000. Whereas if the individual wants to make If the individual chooses to make voluntary after-tax contributions, the limit is 100% of their self-employment compensation, dollar for dollar, up to the overall limit, $66,000. So in other words, they only need $66,000 of self-employment compensation to be able to end up with $66,000 in their Roth solo 401k. So that's what I meant by when I said that the limit is higher. It's easier to be able to reach the overall limit, right? So just to be clear, the voluntary after-tax contribution limit is the lesser of your self-employment compensation, right? Line 14 of the K-1, less one half of the self-employment tax, and the overall limit. Now, of course, you need to keep in mind that overall limit. So you have to reduce this by any employee or employer contributions made to the solo 401k. Now, what's interesting is that the limit, the voluntary after-tax contribution limit, doesn't go up for someone that's 50 or older, right? It's still $66,000, but it can ignore any catch-up contributions made to the solo 401k. So ultimately, the individual that's 50 or older is still going to be able to contribute those additional funds, but they wouldn't do it as a voluntary after-tax contribution. They would make those catch-up contributions as either a pre-tax or a Roth, the $7,500. Now, even though the voluntary after-tax contribution is a type of employee contribution, because the limit comes from a different section of the code, it's not impacted by contributions made to another retirement plan through an unrelated employer, like a day job plan, unless the other plan is a 403b, where you got to consider the 403b exception, where all the contributions made to the 403b, whether by the employee, the employer, plus any contributions that you would want to make to the solo 401k, the aggregate cannot exceed the overall limit. And then lastly, voluntary after-tax contributions need to be deposited into a separate sub-account. So it's like the Roth contributions, where you got the different sub-accounts, right? This is how someone ends up with 3 different accounts, right? Pre-tax, Roth, and voluntary after-tax, or maybe 6 if they have 2 spouses that are both working in the same business, both participating in the same solo 401k, and each spouse has pre-tax, Roth, and after-tax. So now let's start to apply what we've learned to some different scenarios to illustrate some of these key points. So the way that we're going to go through this is we have a baseline scenario, and then we're going to change and tweak different elements to illustrate different points. So our baseline scenario is a self-employed business that is taxed as a partnership, multi-member LLC taxed as a partnership. One person who's over 50 doesn't make contributions to another plan, like a day job plan. Their goal is to first maximize pre-tax contributions to reduce their taxable income. And then to the extent that they're able to make any more contributions, make those contributions as either a Roth or voluntary after-tax. Let's assume the individual has $100,000 of self-employment compensation. Remember, that's line 14 of the K-1, less one half of the self-employment tax. And let's assume that all employer contributions are made as pre-tax contributions for the good reasons discussed above. So in this baseline scenario, the individual is going to be able to contribute $22,500 as an employee pre-tax for 2023, because it's 100% of their self-employment compensation, up to $22,500. For 2024, they're going to be able to contribute $23,000 as a pre-tax employee. In terms of the employer contribution limit, they'll be able to contribute 20% of their self-employment compensation, or $20,000. And then they're going to be able to contribute the difference up to the overall limit as a voluntary after-tax, right? Because remember, the voluntary after-tax contribution limit is 100% of their self-employment compensation, dollar for dollar, up to the overall limit, but you still got to keep that overall limit in mind. So here they've contributed $22,500 to their pre-tax account, another $20,000 as an employer pre-tax contribution for 2023. So that leaves them another $23,500 for 2023 that they can contribute as a voluntary after-tax. And then they can move that over to their Roth solo 401k account. For 2024, they'd be able to contribute another $26,000, because remember, the overall limit went up to $69,000. So that $26,000 would go into their voluntary after-tax before it gets moved over to their Roth solo 401k. So at the end of the day, for 2023, this individual would have $42,500 in their pre-tax solo 401k sub-account, $23,500 in their Roth solo 401k sub-account. For 2024, they'd have $43,000 in their pre-tax solo 401k sub-account, $26,000 in their Roth solo 401k sub-account. So now let's go back to the base and change one of the scenarios. Instead of $100,000 in self-employment compensation, let's assume that they have $50,000. So what does that change in terms of what they can contribute? So it doesn't change their pre-tax employee contribution amounts. That's still the same, $22,500 for 2023, $23,000 for 2024. The employer limit changes because now it's 20% of $50,000 or $10,000. And then their voluntary after-tax contribution limit changes. Because remember, you can't save more than you earn, right? The voluntary after-tax solo 401k contribution limit is the lesser of their self-employment compensation, which is $50,000, or the overall limit. So for 2023, they're going to be able to contribute $17,500 as a voluntary after-tax, which they could then move over to their Roth solo 401k. So at the end of the day, they'd have $32,500 in their pre-tax solo 401k sub account, $17,500 in their Roth solo 401k sub account. For 2024, they'd have $33,000 in their pre-tax solo 401k sub account, $17,000 in their Roth solo 401k sub account after they made a $17,000 voluntary after-tax contribution that was then moved over to their Roth solo 401k. So now let's go back to the base, back to $100,000 of self-employment compensation. But here, let's assume the individual has actually maxed out contributions to a day job plan. They made $22,500 in employee contributions for 2023, $23,000 for 2024. So in terms of what they can contribute to the solo 401k, they're not going to be able to make any employee contributions, right? Because that employee contribution limit applies at the employee level. And they've already maxed out. They've already filled up this bucket to their day job plan. But their employer contribution limit, their voluntary after-tax contribution limit is not impacted by contributions made to another plan. So they're still going to be able to contribute 20% of their self-employment compensation or $20,000 as an employer pre-tax. And now they can make the difference up to the overall limit. So another $46,000 for 2023 deposited into their voluntary after-tax, $49,000 for 2024. So at the end of the day, they're going to have $20,000 in their pre-tax solo 401k sub account for 2023, $46,000 in their Roth solo 401k sub account for 2023. For 2024, they're going to have $20,000 in their pre-tax solo 401k sub account and $49,000 in their Roth solo 401k sub account. So now let's go back to the base. Now they don't make any contributions to another plan. They got $100,000 of self-employment compensation, but here they're not interested in making pre-tax contributions. They're only interested in making Roth or voluntary after-tax. So they would still make the same employee contribution amount, but instead of depositing it into their pre-tax solo 401k sub account, they would deposit it into their Roth solo 401k sub account. Let's assume that they're not going to make any employer contributions because they're not interested in making pre-tax contributions. So now they would just make the difference as a voluntary after-tax solo 401k sub account contribution. Right. So for 2023, that'd be another $43,500 that would be deposited into that voluntary after-tax sub account before it gets moved over to their Roth solo 401k sub account. For 2024, there would be a $46,000 voluntary after-tax contribution that would then be moved over to their Roth solo 401k sub account. So at the end of the day, they'd have $66,000 in their Roth solo 401k sub account and $69,000 in their Roth solo 401k sub account for 2024. So now let's go back to the base. Same scenario as the base scenario, but here there's two participants. Let's say it's a husband and wife. They could be both realtors. They're both working in the same business. They're both self-employed, and they both have the same profile, right? They're both under 50. They don't make contributions to another plan. Their goal is to maximize pre-tax and then make any additional contributions as Roth or after-tax. And they have $100,000 of self-employment compensation. So really the limits are the same as the baseline scenario. The key takeaway here is that it applies at each person's level, right? It's based on each person's age, each person's self-employment compensation. So each person is going to be able to contribute these amounts into their own accounts, right? And they would end up with 6 accounts, right? The pre-tax, Roth, and voluntary after-tax for each person. So now let's go back to the baseline scenario. So now we're going to assume the individual is 50 or older, right? It's now just one person, $100,000 of self-employment compensation. They don't make contributions to another plan. So here they're going to be able to put the same $22,500 into their pre-tax employee, but then on top of that, they're going to be able to make a $7,500 catch-up contribution for 2023. For 2024, they're going to be able to make a $23,000 pre-tax employee contribution plus an additional $7,500 as a catch-up. Their pre-tax employer limit is the same, right? It's 20% of self-employment compensation. And now they're going to be able to make the difference as a voluntary after tax. So this is a good scenario as it illustrates that when someone's 50 or older and they're making a catch-up contribution, it's made as either a pre-tax or Roth employee contribution, not as an after tax. Okay, so now let's go to the back to the base scenario. It's back to one person under 50 years of age. They've maxed out contributions to their day job plan, but here their goal is to only make Roth or after tax contributions. So they're not going to be able to make any more employee contributions to the solo 401k because they've already hit the limit under their day job plan. They're not interested in making employer contributions because those are pre-tax contributions. In our scenario, we're assuming that they're not interested in making those employer contributions as Roth contributions for the good reasons discussed above. So that means they're going to make the full contribution amount, $66,000 for 2023, $69,000 for 2024 as a voluntary after-tax contribution, which then could be moved over to their Roth solo 401k. So at the end of the day, they'd have $66,000 in their Roth solo 401k for 2023, $69,000 in their Roth solo 401k for 2024. So now let's go back to the baseline scenario. Now the person's 50 or older. Again, they max out to their day job. Again, their goal is to only make Roth or after tax. So it's going to be the same, right? They're not going to be able to make any employee contributions because they've already hit the limit under their day job plan. They're not interested in making employer contributions as pre-tax contributions. They're only interested in making Roth or after tax. So they're going to be able to make the same voluntary after tax contribution of $66,000 for 2023, $69,000 for 2024. So this is a good illustration that the catch-up contribution cannot be made as an after tax. It's the $7,500 is made as either a pre-tax or Roth employee. And since this individual maxed out, they made that catch-up contribution to their day job plan, they're not going to be able to make any more catch-up contributions to the solo 401k. Okay, now let's go back to the base. It's two participants, they're under 50. Each person maxes their contributions to their day job. Each person is only interested in making Roth or after tax. And each person has $100,000 of self-employment compensation. So the limits are the same as what we talked about in the prior scenario. So this is just another good illustration of how the limits apply at each participant's level. So based on each participant's age, each participant's self-employment compensation, the goal that each participant has, right? Whether they're trying to make pre-tax versus Roth. And since we're assuming that here each participant has the same profile, each person is going to be able to make the same contribution amounts. In this case, $66,000 as a voluntary after tax for 2023, $69,000 as a voluntary after tax for 2024. So hopefully that helps as we go through those good scenarios to help illustrate the rules we talked about at the outset. So now let's turn and take a look at one of our online tools, which is our calculator. If you go to our website, mysolo401k.net, there's a menu that goes left to right, home, about, solo 401k. If you go all the way over to the right under learn, and then click on online tools, you'll be able to access our calculator, right? Where you'll be able to enter your specific information, be able to save a PDF copy. So for a business that is taxed as a partnership, like a multi-member LLC, right, with your filing at Form 1065, you're going to select unincorporated sole proprietorship. You're going to enter the net income from line 14 of Schedule K-1 that you receive as a partner. So then the calculator will reduce that amount by 1/2 of the self-employment tax. How do I make contributions? So of course you can always make those contributions as by check, right? In that case, you would make the check payable to the name of the solo 401k. It would be good to write annual contribution on the memo section of the check. From a solo 401k perspective, it's totally acceptable for those contributions to be made via electronic transfer. Now, we don't have access to any of our customers' accounts at the same time. We're very hands-on in helping clients open up accounts at the bank or brokerage of choice. And we've helped clients open up accounts at hundreds of different banks, credit unions, many different brokerages like Fidelity, Schwab, etc. So of course, you have to check with the financial institution that holds the account to determine their process to receive an electronic deposit of funds from an external account. It's noteworthy that many of the brokerages where our clients want to have their accounts at and where we help them open up accounts don't allow for an electronic deposit from an external account where the name on the external account doesn't match the name on the account of the brokerage. So in other words, it's not open. The external account is not under the name of the plan, right? Because of course, the account of the brokerage is going to be opened under the name of the plan. So let's assume that the external account is a business account or a personal account that you want to transfer the funds to make a contribution to the plan. So again, the brokerages generally won't allow for that electronic deposit from an external account. So of course, one workaround would be to open up a non-retirement brokerage account at the same brokerage to first deposit the funds into from that external account and then move the funds internally from that non-retirement brokerage account to the brokerage account that was set up for the solo 401k. Now, one exception to that general rule is Fidelity. Fidelity does allow electronic deposits from an external account where the name doesn't match the name on the brokerage account based on our experience and client feedback. So of course, when we're talking about making contributions, it's good to remember that each person that's participating in the solo 401k, right? Like take the spouse scenario where both spouses are working in the same business, both spouses are participating in the solo 401k. So each participant is going to deposit his or her contributions into their separate sub account. It's also good to remember that you need separate sub accounts for different types of funds like pre-tax versus Roth versus voluntary after tax. What is the deadline, right? Continuing with the mechanics of making contributions. Well, per IRS publication 560, which is the landmark guidance for self-employed plans like solo 401ks, for a plan that is set up by the end of the year. So say you signed up with us by December 31st, 2023, that's going to preserve the right for you to make all types of contributions by the business tax return deadline, including any timely filed extension. So March 15th for a business tax as a partnership, or if you file a timely extension, September. Now, even if a plan was not set up, even if you didn't sign up by the end of last year, you could still set up a plan here in 2024 and make contributions as long as you're making employer or after-tax contributions. It's too late to make employee, but you could still make employer or after-tax contributions by the business tax return deadline, including any timely filed extension. So this is a good chart here as it talks about, okay, well, what are the deadlines for 2023? Well, it depends on how the business is taxed. For a partnership, it's March 15th or September 16th if you file a timely extension. For whether that's a business tax as a partnership, could be an LLC tax as a partnership, right? The 1065 deadline. For 2024, the deadline is March 17th of 2025 or September 15th of 2025. Again, it could be an LLC tax as a partnership, any type of business, self-employed business where you're filing a 1065. So now let's talk about more on the mechanics. How do I report contributions? Well, it depends on the type of contribution that you're referring to. If it's a pre-tax employee contribution, it's going to be reported on line 16 of Schedule 1 of your 1040, as well as line 13 of your K-1 using code R. If it's a Roth employee or a voluntary after-tax contribution, it's not reportable. Now, it's noteworthy if we're talking about the voluntary after-tax contributions, those get deposited into that separate voluntary after-tax account before they get moved over to either the Roth solo 401k or Roth IRA. So the initial contribution deposit, that is not reportable, but the subsequent transfer from the voluntary after-tax to either the Roth solo 401k or Roth IRA is reportable on a Form 1099-R for the year for which the transfer is done. So someone might be making a 2023 voluntary after-tax contribution here in 2024 before the business tax return deadline, including any timely filed extension. And then, of course, subsequently in 2024, then moving the funds from the voluntary after-tax solo 401k sub-account to either the Roth solo 401k or Roth IRA. So that subsequent move will be reported on a 2024 1099-R. Now let's talk about the employer contributions in terms of how those are reported. So regardless of whether it's a pre-tax or Roth employer contribution, it's going to be reported as tax deductible on the employer's return for the year for which the contribution is being made. So on line 16 of Schedule 1 of the 1040, as well as line 13 of your K-1 using code R. Now, if that contribution is a Roth employer contribution, it's then going to be reportable as taxable to the employee for the year of the deposit using the Form 1099-R. So it'd be from a reporting perspective, it's the same as if the individual had made a tax deductible employer contribution and then immediately processed an in-plan pre-tax to Roth conversion. Now, you don't literally have to go through those steps in terms of putting it first into the pre-tax before you move it to the Roth, but from a reporting perspective, it's going to be the same. So someone might be making an employer contribution for 2023, gets reported on the 2023 tax returns, but then if it's deposited in 2024, the 1099-R is going to be issued for the year of the deposit as taxable to the employee for the year of the deposit. So that 1099-R will be issued for 2024. How do I convert after tax to Roth, right? So that's how you're making these mega backdoor Roth contributions. You're taking advantage of the fact that the voluntary after tax contribution limit is higher than your typical Roth employee limit or even Roth employer, because you can make 100% of your self-employment compensation dollar for dollar as a voluntary after tax contribution up to the overall limit. But then those funds need to be moved from the voluntary after tax solo 401k sub account to either a Roth solo 401k or Roth IRA so that they have the potential for tax-free growth. Because if you have gains inside the after-tax account, those gains are taxable. But once the funds are in either the Roth solo 401k or Roth IRA, now they're going to grow on a tax-deferred basis and potentially be tax-free if when you remove the funds from the Roth solo 401k, you remove it as a qualified Roth distribution. So that, of course, begs the question in terms of the mechanics, how do I convert the funds? Well, of course, you could convert the funds by check. It's also totally acceptable to convert the funds via electronic transfer like ACH or wire. You're moving the funds between the bank and or brokerage account. So we have many folks who want to have the account set up at a brokerage like Schwab. So the process would be, of course, number one, making the contributions. In order to make the contributions, you have to have an account into which to deposit the funds. So as part of the onboarding process, we're asking our clients, okay, where do you want to have the accounts at? So if you choose Schwab, we would pre-fill and prepare the paperwork that Schwab requires, open the requisite number of accounts, right? It could be 3 accounts, a pre-tax, a Roth, and a voluntary after-tax. Then the individual deposits the funds into the voluntary after-tax account and then converts the money either over to the Roth solo 401k brokerage account that would have been set up also at Schwab as an in-plan conversion, which they could do online with a click of a mouse, or they move it over to a Roth IRA, right? It could be a Roth IRA at Schwab or another institution. And then they have to go to our website where they can go 24/7 to let us know about that after-tax to Roth solo 401k or after-tax to Roth IRA transfer. So we have an online form that we use to gather the information that we need to be able to prepare the 1099-R. So we prepare that 1099-R as an optional free service. In other words, no additional charge. But we need to gather the information because we don't have access to the customer's accounts. So, but they could just simply go on there. It's a couple-minute form just to give us the information to put their plan in the queue so we can prepare the 1099-R. So Fidelity is going to work very similar. That's another super popular option, right? You let us know you want to open up the accounts of Fidelity. We prepare the paperwork to open up those accounts. Those are good free accounts. Fidelity doesn't charge anything to set it up. There's no maintenance fee. You got to have the different sub accounts, right? For the Roth versus the after tax versus the pre-tax. So we'd say prepare 3 different sets of paperwork, account opening paperwork. The individual then makes the after tax contribution, then moves the funds over either to the Roth solo 401k, or it could go out to a Roth IRA, right? Like we talked about, you don't need to meet a triggering event to be able to move the funds out. So you can move them out of the plan from the voluntary after tax account to a Roth IRA. You don't have to meet a triggering event if you're trying to transfer out voluntary after tax funds. And then you have to let us know about that transfer so we can capture the information that's needed to be able to prepare the 1099-R. So those forms are easily available on our website 24/7, mysolo401k.net. Upper right, there's a link to forms. So then that prompts a question, right? Should I convert to Roth IRA or Roth solo 401k? So this is a good chart as it helps to break down the key differences. So A Roth IRA is not an employer plan, so distributions can be made at any time, right? So with the Roth solo 401k and 401ks generally, you generally cannot transfer funds out of the solo 401k until you met a triggering event, like being age 59 and a half years of age. Now, one exception to that general rule are those voluntary after-tax contributions, which is why those can be transferred out to a Roth IRA. But once the funds are in that Roth IRA, it's going to be like any Roth IRA funds, right? Where you observe those ordering rules, right? You first take out the contribution amount, the basis, then you can move on to conversions, etc. But again, so that would be a reason why folks might want to move it over to a Roth IRA, because you have more flexibility in being able to take the funds out. Now, another difference historically is that Roth IRAs are not subject to required minimum distributions. Since Secure Act 2.0, no RMDs now apply to Roth solo 401k funds starting in 2024. So that features have, that consideration has been aligned basically between the two types of accounts. Participant loans are not permitted from any type of IRAs, including a Roth IRA. Whereas a Roth solo 401k, as long as the plan allows it, like ours does allow for loans. So that would allow you to access some emergency cash without having to pay taxes or penalties. Now, of course, that's to be documented as a loan. We prepare the required loan documents as part of our service. Of course, that's to be paid back according to the payment schedule, right? So you'd be able to borrow from your Roth solo 401k, right? You could borrow up to 50% of the balance, the total balance of the plan, not to exceed $50,000, has to be paid back in monthly or quarterly payments, equal payments of principal and interest. The interest is either going to be prime plus 1%, or it could be a CD rate plus 2%, with those payments spread out over a 5-year term. And it has to be documented. And again, we prepare those loan documents like the payment schedule, et cetera, as part of our service for no additional charge. Last difference here we have highlighted on this good slide is UDFI. So many individuals, their motivation in setting up a plan is not just being able to make mega backdoor Roth contributions or large contribution amounts, right? They also want to invest in alternative investments like real estate. So when someone is investing in real estate, sometimes they want to use debt, right? So it's possible to use your retirement money along with debt to make a real estate investment, but it has to be a special type of debt called non-recourse financing. In other words, the only recourse of the lender is the property itself, right? Like the retirement account holder cannot personally guarantee that loan to the retirement account to invest in real estate. So that's not a difference, right? Whether it's a Roth IRA real estate investment or a Roth solo 401k real estate investment, it has to be that's financed with debt. It has to be non-recourse debt. The difference is that if you have income inside your Roth IRA that arises from a debt financed investment, that income is going to be subject to a tax payable by the Roth IRA. And that tax is referred to as unrelated debt finance income tax. Whereas there's an exception to a Roth that applies to a Roth solo 401k when there is income inside of a Roth solo 401k that derives from real estate, where that real estate is subject to acquisition indebtedness. In other words, debt finance real estate inside your Roth solo 401k, there's going to be an exception to that UDFI tax. So that would be an advantage of the solo 401k versus the Roth IRA. So now let's talk about a common question, which is whether there's a deadline to convert the money from the voluntary after-tax funds, right? Good question, right? Because as it's well known, right, there is a deadline to, of course, contribute the voluntary after-tax funds, but there's no deadline to subsequently move the money from the voluntary after-tax solo 401k sub-account to the Roth solo 401k, right? So someone might be making their after-tax contribution for 2023 all the way up until the extended deadline, say September 16th of 2024, right? If they file a timely extension for their Form 1065. But they can move the money anytime after from the voluntary after-tax solo 401k sub account over to their Roth solo 401k sub account. No deadline to move it over. Hopefully that makes sense. Now that is going to be, we talked about how the contribution is not reportable, but the subsequent transfer is. So that's going to be a Form 1099-R, and we handle that as an optional free service. Clients just have to give us the information by submitting a form on our website. If you go to our website, mysolo401k.net, upper right, there's a link to forms. And again, that's going to be reportable for the year of the transfer, not the year for which the contributions were being made. So you might have someone that's making 2023 contributions in their voluntary after-tax account during 2024. Then let's say they also make additional 2024 voluntary after-tax contributions, and both source of those funds, both the 2023 contributions plus the 2024 contributions, are moved over to say a Roth solo 401k in 2024. That it's going to be one 1099-R that's going to show the transfer of both funds, and that's fine because the individual can go ahead and make 2024 contributions here in 2024, as long as they got the 2024 self-employment income to justify the contribution, and then move over the funds here in 2024. So now we want to illustrate again the accounts, right? Because that's a real key part when it comes to mega backdoor Roth contributions. You have to keep those after-tax contributions in a separate account to be able to satisfy the way the pro rata rules apply to solo 401ks. They apply at the account level, which is why you have to put the funds into a separate after-tax account. So you can just move over the after-tax funds to a Roth solo 401k or Roth IRA, notwithstanding that you might have other funds in the plan, like in your pre-tax account or a Roth solo 401k sub account. So here in this good illustration, you have one person, they have pre-tax money, right? They might have rolled over money from a former employer plan or an IRA. And they've also got Roth and after-tax accounts to be able to facilitate a mega backdoor Roth solo 401k contribution. And then if you have two participants, they've got 6 accounts, right? Each has pre-tax, Roth, and after-tax. Or let's say you got one person and they want to move their voluntary after-tax funds out of the plan to a Roth IRA. They might just have 2 accounts or maybe even 1 account. But let's say they have pre-tax money because they rolled over money from a former employer plan or a non-Roth IRA. Then they're also making the voluntary after-tax solo 401k contributions that they want to transfer out to a Roth IRA. Okay, great. That takes us to the end of the slides regarding the contribution rules for partnerships. Now let's talk about the $1,500 tax credit. So we got some quick bonus content here at the end. So, and then we can go to any questions that you have. So under the Secure Act, right, there was a number of tax credits that became available to encourage small businesses to offer us a 401k plan. So there are a number of those credits. One of those credits, which is the auto participation credit, is the credit that we want to focus on here. Now, in contrast to say the startup cost credit, which you might also read about if you're doing some research. So the startup cost credit is only available to businesses that have non-owner employees, what they call non-highly compensated employees. So that means effectively that the startup cost credit could not be taken for a business that's setting up a solo 401k plan. But the automatic participation credit doesn't have that same limitation. So an owner-only business that sets up a solo 401k plan that includes the automatic participation feature is eligible for the $1,500 tax credit. So it's a $500 per year credit for 3 consecutive years. Could be for a new plan, or if someone has a basic plan at a discount brokerage, like say a Fidelity or Schwab or a Vanguard, et cetera, they can upgrade their plan to our plan to be able to include the feature and now become eligible to be able to claim the credit. Unlike the startup cost credit, which as the name implies, is a function of the cost to set up and maintain the plan, you can take the full $1,500 automatic participation credit, even if your cost to set up and maintain the plan is less than $1,500, like is the case with our plan. So if you're setting up a new plan here in 2024, as long as you sign up with us during 2024, you'll be able to claim the $500 credit starting when you file your 2024 taxes, and then again for 2 more years for a total of $1,500. Whereas if someone signs up in 2025, they'll be able to claim the credit when they start filing their 2025 taxes, and then again for 2 more years for a total of $1,500. Now, if someone converts their existing solo 401k plan, like you talked about the basic plan at a discount brokerage, like a Vanguard or an E-Trade or Fidelity, et cetera, if they do that here in 2024, they're going to be able to claim the $500 per year credit starting when they file their 2024 taxes, and then again for 2 more years. Whereas if someone converts their existing solo 401k plan next year in 2025, they'd be able to claim the $500 per year credit starting when they file their 2025 taxes. Like we talked about, the ability to claim the credit is not a function of the costs. So our costs, for example, are $650. That includes the $525 establishment fee plus the first $125 annual fee. If someone signs up again in 2024 or converts an existing plan in 2024, they can claim the $500 credit when they file their 2024 taxes, which means the net cost for the first year is $150. Now, next year, our annual fee of $125 would be due on the anniversary date, right? So say this time next year, if you were to sign up now. So, but again, you'll be able to claim the full $500 credit, even though your costs are less than $500. They're $125. So effectively, your net cost is a negative $375. Likewise, in 2026, the value of the credit exceeds your costs by $375. And that's okay because your ability to claim the solo 401k tax credit is not a function of your costs. And it's helpful and important to recognize that this is a tax credit, not a tax deduction. With a tax deduction, you reduce your income upon which your tax liability is calculated. Whereas a tax credit is better because it reduces your tax liability dollar for dollar. So you first figure out your liability, then you can reduce that tax liability dollar for dollar by $500 for 3 consecutive years for a total of $1,500. So that in order to be eligible, right, you have to be eligible to set up a plan and then set up a plan like our plan that includes the automatic contribution feature. So what is the automatic contribution feature? Well, it sets a default 3% contribution percentage, but under the terms of that automatic contribution feature, the employee, meaning you as a solo 401k owner, need to be given the option to opt out of the default 3% contribution amount. And this doesn't mean you lose the ability to make contributions. It just means now you have all the flexibility that naturally comes with the solo 401k plan to be able to make contributions whichever amount or schedule or interval you prefer, of course, subject to the limits and the deadlines. You even have the option of not making contributions, right? So even if you don't make contributions, you would still be eligible to claim the credit. Again, if you have an existing solo 401k plan, you can add the feature to the plan and then be able to claim the credit. You claim the credit by filing Form 8881, which is really just the first step in the process. We have a deep dive walkthrough that we've done for all these different business variation types, right? Whether it's for partnerships, S corps, sole proprietors, because that's really the first step in the process to be able to claim the credit. And we walk through all the steps to where it ends up on your tax return. So now you can really reap the benefit of the credit to make it easy for you, or you could just forward it on to your tax advisor. So just a quick example, Lindsay is self-employed. She already has a solo 401k plan. She amends her plan here in 2024. Now she's going to be eligible to claim the credit of $500 when she files her 2024 taxes. And then again for 2 more years for a total of $1,500, as long as she continues to maintain the plan with the auto contribution feature. Whereas Brad doesn't have a solo 401k, but he's eligible to set up a solo 401k because he's a solo practicing attorney with no employees. As long as he signs up here in 2024, he'll be able to claim the $500 tax credit when he files his 2024 taxes. And then again for 2 more years for a total of $1,500, as long as he maintains the plan with the auto contribution feature. So that takes us to the end of the slides. Let's just highlight some resources. We have our community, mysolo401k.net/my community, where we host daily live webinars. We go live every day, 1 p.m. Pacific, 4 p.m. Eastern. We have forums where you can post questions 24/7. We have a deep dive, video and video and webinars library. We've got hundreds of videos and webinars in there where you can, just really learn. You can share the knowledge. There's lots of great ways to engage. So please do so at the mysolo401k.net/my community. It's always, all are welcome. It's free to join. And again, we've got a number of great webinars coming up on the docket. So just to highlight those, next week we'll be having our sole proprietor, single member LLC deep dive contribution guides, webinars. So like this, but really focused on businesses that are taxed as sole proprietors, or maybe a single member LLC where the income is reported on Schedule C of your 1040. Then we're going to have a series of webinars that are focused on how much income do I need to be able to maximize contributions. So please subscribe so you get notifications of all the webinars, you get access to all the recordings, so you can continue to learn and engage. We really appreciate all the good participation. So does someone need to make W-2 income to use a solo 401k? So you have to be self-employed and be reporting earned self-employment compensation on your taxes. So what that means depends on how your self-employed business is taxed, right? So for a business that is taxed as an S Corp or a C Corp, that would be W-2 wages that you receive from your S Corp as a C Corp or a C Corp. For a business that is taxed as a sole proprietorship, like a single member LLC, that would be reporting income on Schedule C of your 1040. For a business that is taxed as a partnership, right, that would be reporting income on line 14 of your K-1, less 1/2 of the self-employment tax. So ultimately, you got to have that self-employment activity to be able to demonstrate that you are self-employed, you have earned self-employment income, because a 401k is really for people who work, right? A solo 401k is for self-employed people. So it's not for people that just have investment income or owner income. You got to have that earned self-employment income. Now, there really is no minimum amount of earned self-employment income that you need to report in order to be eligible. It just needs to be legitimate, consistent, but of course, your ability to contribute to the plan. So if your goal is to be able to make contributions, your ability to contribute to the plan is a function of your earned self-employment income. So there's no minimum amount that you would need to be eligible to set up a plan, right? As long as you don't have any full-time employees working for your business. But once you set it up, if then when you're determining how much you can contribute, that's going to be a function of your earned self-employment income. So if you don't have a relatively high amount of earned self-employment income, you wouldn't be able to contribute a relatively high amount to the solo 401k. Hopefully that helps. Thank you for the good question. When I turn 50, how soon can I contribute more? So if you turn 50 in that year, you're going to be able to contribute the $7,500 catch-up contribution for that year, right? You could turn 50 on December 31st, and you'd be able to make that catch-up contribution for that year. It's not prorated, for example. Great question. So again, I mean, if you can work with one question is how you report your self-employment income. And that's a question for you and your tax advisor. But once you've determined that you're going to report earned self-employment income, and you don't have any full-time W-2 employees working for any business owned by you or a spouse, if any, now you're eligible, right? So you could decide with your tax advisor, well, I'm going to report income on Schedule C. And that would be a decision for you and your tax advisor. And if that's what you end up reporting, and that's legitimate and that's consistent, and you don't have any full-time W-2 employees, you can set up a solo 401k. You don't necessarily have to run payroll in order to be eligible to set up the solo 401k. Hopefully that makes sense. Thank you so much for the good questions. Thank you so much for the good participation. Please continue to engage. Please subscribe so you get all the notifications. Please come to the community so you can participate and learn and share the knowledge. mysolo401k.net/my community. So thank you so much. It's been a great session. We do appreciate it. Until next time.